something just broke in the global pricing system. For years, silver looked boring, slow, trapped, pushed down, pulled back, and recycled inside the same narrow ranges decade after decade. That calm wasn't natural, it was enforced. And now the behavior has changed. Not gradually, violently. What used to be slow accumulation has flipped into vertical movement, where time compresses and prices stop respecting old ceilings. Here's the contradiction. This isn't being driven by excitement or speculation. There's no crowd euphoria, no celebration. What's driving this is stress. Pressure building underneath the assets that are supposed to feel safest. And when that pressure releases, it doesn't ask permission. This matters to you whether you follow metals or not. Because when long-standing price structures snap, it's not just charts that reset. It's purchasing power, savings, the cost of waiting. The unsettling part is this. The market isn't signaling a peak. It's signaling escape from control. And once an asset leaves a 50-year box, it doesn't politely step back inside. The question now isn't how high it goes, it's what finally forced it to break. What's happening here didn't come out of nowhere. It's the result of pressure being misread for stability. Most coverage frames this as a commodity story. Silver is up, volatility is back, charts look different, but that lens is too narrow. This move isn't about silver deciding to matter again. It's about the system around it starting to fail at holding things in place. At the center of the shift is something most people never watch until it breaks. Sovereign debt. The assets meant to anchor confidence. The long end of the bond market. When those instruments wobble, everything priced off them starts behaving differently. And that's exactly the timing you're seeing now. Here's the pattern worth noticing. As confidence in long-term debt weakens, central banks are forced to step in. Liquidity expands, support replaces discipline. On the surface, this looks like stabilization. Underneath, it's dilution. Now ask the question most headlines avoid. If the safest assets need constant rescue, what does that say about the currency they're priced in? This is where the story reframes. Silver isn't reacting to demand, it's reacting to credibility loss elsewhere. And when credibility moves, it rarely moves alone. Here's the claim that sharpens everything. The paper market and the physical market are no longer telling the same story. On screens, silver still looks liquid. Contracts trade. Prices update. Volume prints. Everything appears orderly. But behind that surface, behavior changes. Large players aren't extending exposure. They're pulling metal out of the system, away from claims toward control. And that shift only happens when confidence in settlement starts to thin. This is the detail most people miss. When demand stops asking for exposure and starts asking for delivery, the market stops being about price discovery and starts being about access. Paper can multiply infinitely. Physical metal cannot. And the moment that difference matters, leverage flips from an advantage into a liability. Notice what's missing from the official narrative. There's no reassurance about availability, no expansion of buffers, no visible effort to narrow the gap. Instead, the system keeps functioning as if belief alone will hold it together. This is where the story flips. The market isn't short of metal yet. It's short of trust. And once trust becomes the scarce input, price is forced to catch up fast. That's when moves stop being gradual and start being abrupt. This is where escalation becomes visible. When a system starts losing trust, the first response is denial. The second is normalization. Behaviors that would have caused alarm before get reclassified as temporary issues, logistical noise, or one-off disruptions. But repetition turns anomalies into a pattern, and patterns change expectations. You can see that shift now. Physical bottlenecks aren't treated as emergencies. Delays are tolerated, premiums widen without protest. What should feel abnormal starts to feel routine. That's not stability returning. That's the system adapting to strain. We've seen this dynamic before, not just in metals, but whenever supply chains collide with financial abstraction. At first, markets insist the paper layer is enough. Then reality intrudes. And once it does, adjustments don't happen smoothly. They happen in steps that feel manageable until they suddenly aren't. Here's why that matters. When normalization sets in, it removes urgency to fix the underlying problem. Pressure keeps building quietly, and the longer it's ignored, the more violent the eventual repricing becomes. This is the phase where control still looks intact, but only from a distance. Up close it's already slipping. Now the stress starts stacking instead of spreading out. It's not one failure, it's several small ones landing close together. Processing slows, settlement stretches, certain forms of supply quietly disappear from circulation. None of these on their own would make headlines. Together they remove flexibility. And flexibility is what keeps markets from snapping. What's striking is how behavior changes downstream. Dealers hesitate to commit capital. Turnaround times extend. Cash flow tightens in places that rely on constant movement. This isn't panic, it's caution. And caution, when it spreads, acts like a brake on the entire system. Here's the part that should make you pause. When liquidity problems appear at the edges first, they rarely stay there. They migrate inward. Retail absorbs it, then intermediaries, then institutions. Each layer passes the pressure forward until there's nowhere left to pass it. Ask yourself this: what happens if this continues? If delays become normal? If availability turns conditional? Because once markets lose their ability to clear smoothly, they don't slowly heal. They reset. Now zoom out to where this lands in real life. When systems tighten, the impact doesn't announce itself. It shows up as friction. Things take longer, cost more, require decisions sooner than you're comfortable making them. The margin for waiting shrinks, and the margin for error shrinks with it. You feel it when prices stop feeling anchored, when quotes expire faster, when availability becomes something you have to ask about instead of assume. None of this feels dramatic in isolation, but together it changes how people behave. They rush decisions, they accept worse terms, they trade flexibility for certainty. This isn't about market ideology or asset preference, it's about exposure. When repricing happens, it doesn't hit portfolios first, it hits planning, budgets, the quiet assumptions people make about stability. That's why this matters even if you've never touched a metals chart. The effects move outward, not inward. If this pattern feels familiar, say so in the comments. Because recognition always comes before reaction, and reaction is already starting to form. Here's the part that explains why this keeps happening without stopping. Systems like this don't fail because no one sees the risk. They fail because incentives reward delay. Leverage favors rolling obligations forward. Institutions benefit from maintaining the appearance of stability longer than it's justified, and fear keeps participants inside structures they no longer fully trust, because stepping outside feels more dangerous than staying in. That's the mechanism. As long as confidence can be staged, pressure can be deferred. Prices don't reflect truth, they reflect tolerance. How much strain participants will accept before demanding certainty instead of promises. This is why physical constraints matter so much at moments like this. Not as a belief system, but as a boundary. When everything depends on someone else honoring a claim, control becomes conditional. Systems built on abstraction work incredibly well until confidence thins. Here's the uncomfortable insight. Power doesn't vanish when systems strain. It concentrates. Those closest to issuance, settlement, and rulemaking gain room to maneuver. Everyone else adjusts around them. That isn't accidental. It's structural. Now look forward, because momentum doesn't stall on its own. From here the trajectory splits, but neither path restores comfort. In one version, pressure keeps building quietly. Interventions appear just often enough to suppress panic, but not enough to rebuild trust. Volatility becomes background noise. Markets function, but only barely. This path stretches the system thinner over time until a minor trigger forces a major adjustment. In the other version, repricing accelerates. Constraints surface faster than messaging can manage. Moves that were once absorbed become visible. Behavior shifts from optimization to urgency. Access starts to matter more than timing. And once that shift happens, the pace no longer belongs to policymakers. What matters is this: both paths lead to the same destination. The difference is speed, not direction. Either the reset comes slowly through erosion or quickly through compression. Watch the signals already aligning, time frames tightening, reactions sharpening, positioning changing before explanations arrive. Because when markets move in anticipation instead of response, the next phase is already forming, and it rarely announces itself in advance. Here's the frame that makes the entire story click. This was never just about silver moving higher. It's about what happens when trust drains out of the structures meant to hold value steady. Prices don't lead that process. Behavior does. And right now, behavior is signaling a quiet shift towards certainty, control, and exit from long-standing assumptions. Every major transition looks confusing while it's happening. In hindsight, it looks obvious. The difference between those two moments is where value transfers hands. Those who wait for clarity usually get it after the adjustment is complete. Reframe everything you've just heard this way. What looks like volatility is alignment. What looks like noise is repositioning. And what looks like a market story is really a signal about the system underneath it. The next phase won't arrive with a headline. It will arrive as a feeling that something has already changed. If you want to understand these shifts before they become unavoidable, stay here. This is where we break them down while they're still forming.